Welcome back to February's market commentary video. I'm Nick Schuurmans, president of Pure Portfolios. Really excited for this month. The title is Lots of Noise, Not Much Signal, meaning a lot going on headline-wise, federal government-wise. However, markets have been pretty resilient, and all of the rules in which we follow are still flashing risk on. I'll get into some of that, how we make investment decisions, separating signal and noise, what's meaningful from what's meaningless. So let's get into the graphs. We've written a lot of content about the most important question for investors at this juncture of the market cycle. And it has nothing to do with the White House, has nothing to do with the president, tariffs, trade, or any of that. It has to do with, will the massive bet in AI pay off? Many of these large companies, the Mag 7 as they call them, explain a good chunk of the S&P 500's performance. A lot is riding on this astronomical bet in AI. So we track these big companies very, very closely. And thus far in 2025, the AI trade has taken a bit of a breather. So what I'm showing you now is the Mag 7 companies with the S&P 500. This is as of the market close on 225. The S&P is up about 1%. And you can see a lot of these high-flying names have taken a breather the first part of 2025, with the exception of Meta, although you can see they've had a pretty good sell-off over the past couple weeks. And if you've been reading our blog, you'll know that one of our themes for 2025 was future returns for the S&P 500 are going to be challenged. Just because how far we've come, we're trading at the richest levels over the past 30 years. From where we're currently at, history would suggest future returns are going to be lower. They could hover around zero. Now, that's not a promise of what's to come, but again, I think investors would do well to lower their expectations for U.S. large cap stocks going forward. Okay, markets tend to be trend heavy. So what we have here is the S&P 500 performance from 220 through the end of the year, 1953 to 2025, meaning if markets get off to a good start, how does the rest of the year look? If markets get off to a bad start, how does the rest of the year look? So this light blue, let's look at the up more than 5%, which is the light blue. So when markets are up from the start of the year to 2020, what does the rest of the year look like? When we're up more than 5%, markets tend to be quite positive the rest of the year. When we're up less than 5%, which is the green line, markets tend to do a little bit better. So the mental shortcut here is if markets start good, they usually end good. When markets start poorly, they usually struggle for the rest of the year. Now, again, this is not a promise of what's to come, but trends and momentum in markets are real, and this does a good job of framing that. Just for context, I think as of 220, the S&P was up like 3.5%, so we'd be tracking the green line if everything holds. 22 examples from 1953 to 2025. This is one of my favorite charts. I've shared this quite a few times. This goes back to 2008, highlighting all the things there was to worry about. Headlines going back over the past 20-ish years. So the takeaway is if you were to ask the average person on the street what the optimistic case was for stocks or what the negative case was, it's really easy to rattle off the negative case. There's always no shortage of things to worry about when it comes to equity investing. And it's not a bug in the system. It's not a glitch. Volatility, uncertainty, fear. This is the cost of admission to be an equity investor. You can't get 8 or 9% a year, which is the long-term average for the S&P, without the occasional ugly market. Okay. So whatever you worry about, know that uncertainty is nothing new. And I always say, when people mention unprecedented uncertainty, that just tells me they haven't engaged with history. There's never a time in markets where there's nothing to worry about and the market says, it's a green light, go ahead and shovel all of your money into the market, nothing to see here. This is a license to print uninterrupted gains. That's just not a thing. There is always something to worry about. Investing and politics do not mix. Folks cannot help themselves. In this case, this is the University of Michigan Consumer Sentiment Index measuring expectations. When this line is trending higher, that means people feel better about their economic prospects. When this line is going lower, that means people feel worse about their economic prospects. So right now we're hovering around 64. We had a run up and a slight pullback recently in the last survey. You know, month to month, these surveys can be pretty noisy. But what I find interesting is when you dissect the responses by political party, Red would be our right-leaning friends. They think future prospects are great. Conversely, our left-leaning friends think the world is going to hell in a handbasket. This is a massive gap. And the only difference when these trends flipped is who's sitting in the White House. Now, if you gave someone a six-pack of beer or some True Serum, they would probably admit their daily life hasn't changed with the transition of power in the White House, nor do global economies or the U.S. economy, which is absolutely massive, change on a dime like that. So if people were being honest, they probably would know that this is absurd. But again, people can't help themselves. Headlines, social media, what our friends are saying takes a lot of our headspace, and it does bleed into how we feel about our economic prospects and potentially how we make investment decisions, which again, history has not been kind to that behavior. So now let's get into the signal, as I call it, some of the inputs in which Pure Portfolios uses to make investment decisions. So this is what we don't do. We don't walk into the office on a Monday and say, I think technology stocks are going to do great, or I think foreign stocks are going to do great. That sounds simple, but it's also how many advisors, many humans make decisions. They use their own personal experiences and use that to explain the world. Well, if we're being honest, our own personal experiences make up 0.0000% of what's going on in the world. It's a very, very small sliver, right? And we don't want our own personal biases, political biases to bleed into the investment process. So everything we do is rules-based. It's quantitative-based. We want to strip emotion out of the investment process. So I'm going to cover several of our rules just to give you some insight. So we call this the three-headed monster. We've talked about this before. The first part of this, the 10-year yield, is essentially flows through to the cost of money for mortgages, for auto loans. So we pay close attention to this. When this line is trending down, that's potentially a cheaper cost of money, which could flow through to the housing market, to the auto market, to the lending market. Okay, so this is a good trend. The US dollar index. So this is the US dollar relative to a basket of global currencies. When this line is going down, that means the dollar is cheaper relative to a basket of currencies, which make our exports more competitive. So a foreign country, a foreign corporation might find US goods more attractive when the dollar is weak, potentially boosting US exports, which would flow through to corporate earnings. This is a good trend. Oil. Obviously, inflation's a big thing. When the price of oil goes down, that flows through to many parts of the economy, most notably to the U.S. consumer with prices at the pump. So when oil is going down, that's potentially more money in U.S. consumers' pocket, which again means they're buying more stuff, which flows through to corporate earnings. So this three-headed monster is very much a positive trend for equities. And conversely, when these lines are going up, that's a more stressful time for equities. So this is high yield spread. And predicting future equity returns is darn near impossible, especially in the short term. This is probably the single best predictor of future equity stress or risk-on environments. This line measures the cost for a lower quality company to borrow above the risk-free rate. So let's say the risk-free rate is 4%. Okay, this line measures what it would cost above that for a lower quality company to access capital. Obviously, when this line is going up, that's capital freezing up. That is lower quality companies getting frozen out of the debt markets, meaning they can't borrow money. Marginal companies would go bankrupt. Investors are very protective in a disruptive economy, disruptive market environment, or a market crisis to lend money. Going back to 2020, obviously this was the pandemic. Everyone was freaked out. Capital markets basically froze up. It was very hard to get access to capital. And not surprisingly, when this line shoots up, that usually signals a downward move in equity markets. And of course, during COVID, during the early part of 2020, the S&P was down 34% in like 40 days or something like that. So massive upswings in lower quality company spreads or borrowing cost signal stress in equity markets. Conversely, spreads are low. When this blue line is going down, that's more of a risk-on environment. Lower quality companies have access to capital. They're borrowing, they're taking risk, they're investing in capital projects. It usually marks a pretty good time for equity markets. So changes in this line is something that we watch very, very closely. And let's go back to 2022. That was the last really difficult market environment that we've had. And you can see as the calendar turned to 2022, this line, this credit spread line started to creep up, and it started to creep up early in the year. That was a canary in the coal mine for a difficult market environment. The S&P 500 was down about 20% in 2022. So we actually were tracking this and selling equities as this line trended up. Okay, we didn't time it perfectly, but this was flashing yellow and eventually flash red, and we went max underweight equities in 2022. Now, conversely, this cycle peak in this credit spread peaked in July of 2022. 3 months later, the market bottomed and raced higher in 2023 and 2024. We're watching is increases from this low level, and it starts to creep up. That could signal the next market correction. And then on the flip side, when everybody's freaking out, markets are down, we're sniffing around for a bottom. And historically, markets tend to bottom 3 to 4 months after credit spreads peak. So again, 3 months after this peak, October 2022, that was the bottom. Markets ascended higher after that. Lastly, the VIX. The VIX is a measure of volatility, measures the distribution or the potential range of outcomes for the S&P 500 based on options pricing. I don't want to get too deep in the weeds, but essentially when the VIX is low, when this blue line is low, that means the volatility is low. When this line is high, it means the volatility is high. And you can see we're showing S&P returns during periods where the VIX is below its long-term average. Its long-term average is 19.5, measured by this black line going back to 1990. So when the VIX is below its long-term average, when volatility is low, S&P returns, and this is annualized, tend to be really good. Compounded annualized growth rate. So when this line is below its long-term average, the S&P's compounded annualized growth rate is really good, marked by these green numbers here. You can see recently the VIX has been below its long-term average. 2023 and 2024 have been absurdly good. Again, we're watching for this line, the VIX. Once it starts to creep up, returns could get challenged. And then you can see on the flip side, when the VIX is above its long-term average, going back 1990, you see returns are lower or negative. So again, inflection points when the VIX gets above its long-term average, when credit spreads start to creep up, that is our signal. Again, has nothing to do with talking heads on TV, what your friends are saying, what social media is saying. This is taking our cues from the market. And this is based on 80 years of evidence. And that goes for the 10-year yield, that goes for oil prices, that goes for how the US dollar is trading. So these are some of our rules. There's about 6 or 7 more, but these are all of our inputs that we're using to make decisions on what to own more of, what to own, or what to own less of. So I hope you enjoyed this. Again, I labeled this lots of noise, but not a lot of signal. Again, our rules are still risk on. We track this every week, and our rebalance window is once a month. So if our rules flip, we have the opportunity to rebalance the first week of the new month. Some months we do nothing. If our rules flip, some months we're quite active. So if you have any questions about how Pure Portfolios works with clients, how we make investment decisions, feel free to shoot us a note at insight@pureportfolios.com. Thanks for watching. I'll see you next month.